Hi everyone, my name is Mark Quinn. I'm a tax advisor and chartered financial planner based in Portugal. And in this video, I'm going to look at investment options for those of you that are either living in Portugal now or looking to relocate here in the future. So if you're coming from the UK especially, the UK has quite an advanced savings and investment industry, and there's lots of choice. You've got national savings structures, you've got pensions, individual savings accounts, general investment accounts. The choice is almost endless. When you come to Portugal, it's a lot more restrictive. So I'm going to summarise the main investment options that you should be considering if you're looking to invest money as a Portuguese tax resident. So the first and most obvious one is cash deposit. This could be either on instant access or fixed rate deposits where you get a better return for tying your money up for longer. Now these have increased in popularity over the last year or so because of the rise in interest rates in the UK, the Eurozone and the US. But the consensus at the moment is that rates have probably peaked, so you've probably had the best interest rate environment there's been for several years, and the expectation now is that interest rates are gradually going to decline over the next few months and years. The other key and critical factor with cash as an investment is that whilst it might be good for short-term cash savings and using it as an emergency fund in the event of unexpected expenditure, it doesn't really act as a good long-term investment. And when I say that, I mean it doesn't really protect your money against the effect of inflation over time. And that's particularly topical at the moment. Over the last couple of years, we've seen inflation reach as high as 10% or even more in the UK. So it's really important that whatever investment you're choosing, you make sure that it has the ability to maintain the real value of your money, so it's not gradually being eroded by inflation. The other issue with cash deposits is the concerns over security. Now in the EU we have the EU compensation scheme, and that's capped at €100,000. So if a bank fails and you're holding more than €100,000 in your account, unfortunately you lose the amount in excess of that. The equivalent amount for a UK bank is £85,000. And the final issue with cash deposits is the effect of tax on those deposits. So if you're holding an account that's whitelisted from a Portuguese point of view, so it's mainland EU for example, or the UK, then you'll have a 28% tax charge on any interest received. A lot of our clients choose to use the Crown dependencies of the UK, so Isle of Man, Jersey and Guernsey. And unfortunately from a Portuguese standpoint, they're actually blacklisted. So you face a higher tax charge of 35% in those jurisdictions. So even if you're getting a relatively attractive rate of 4% at the moment, when you adjust for tax, your net rate, if you're saving in one of those places, would be just 2.6. So it suddenly goes from attractive to not so great. And the important point there is that those blacklisted jurisdictions, as we call them, that tax treatment would be the same even if you had non-habitual residence status, so just bear that in mind. So how do we get our money to work for us? If cash isn't a viable option as a long-term investment, what options are there? Well, a lot of clients we meet at first have generally a mix of share, unit trust, ISA portfolios. And they're better than cash in the sense that if the underlying investments are shares, bonds, property type investments, then they're going to do a better job of maintaining your wealth and growing it over time in excess of inflation. The only problem is in Portugal, if you hold them, as we call them, unwrapped, so you're holding them direct and there's no sort of tax protection around it, then you're going to have tax consequences of that, even if you qualify for the non-habitual residence regime. So if we consider a share or investment portfolio that grows over time, the return actually consists of two components. There's the capital gain and there's the income. So if you look at an investment growing over time. Then the share price itself appreciates in value. So imagine you bought it for £100 and it grows to 150. Then the difference, i.e. the 50, is going to be subject to 28% capital gains tax charge. Again, that applies with or without NHR status. But also you're going to receive income from these investments in the form of a dividend or interest payment. And again, that's going to be subject to 28% tax. So you've got two forms of return, capital gain and income, and both of them are going to be subject to the 28% capital gains tax rules. So you've got the two forms of return, the capital gain and the income stroke interest component, and both of those are going to be subject to 28% tax. The only exception to that is that if you've held the investments for less than 365 days, so it's deemed short-term trading, the capital gain isn't actually 28%, it's actually added to your other income, so the position could be much worse, it could be as high as 48% and above because of the additional solidarity tax you pay. Just another small point here is in respect of the income tax, we said that it would be 28% here. Now most people think that if they have non-habitual residence status, that income is tax-free. And that could be generally true if you were holding direct shares. So if you hold a BP share, Marks and Spencer share, Tesco, etc., and you receive a dividend from it and you have NHR status, then it could be tax-free. However, if the dividend is coming from a fund, so a unit trust, ISA fund, a passive fund like an exchange traded fund, then even with NHR, the dividend is still taxable, again at 28%. It's something that not a lot of people know about. So with that in mind, there are several investment options that we look at when meeting clients. The first one is what's called a general investment account. Now, a general investment account is just a direct investment into a fund. So typically it's an exchange traded fund, otherwise known as index trackers, or a managed fund by the likes of household names like BlackRock, Fidelity, Baillie Gifford's, Fundsmith, etc. When you're investing direct into a fund, you'd face the same tax issues as we've just seen. So you'd have the 28% on the capital gains tax and also the 28% on the income tax. However, there are certain individuals that this would actually be suitable for. And those individuals are typically people that aren't looking to take the benefits when they're residents of Portugal. So if you just want to invest and you might not actually be accessing the funds whilst you're a tax resident of Portugal, you might relocate in the future. And having a general investment account or a directly held fund might not be so bad. The key there will be making sure that you choose an accumulating fund so that there's no dividends paid out, and therefore you won't be subject to the 28% income tax charge because the dividends would be rolling up inside the fund. So again, nothing is black and white when you're considering investment. Sometimes it could be appropriate, but for most of our clients, they are in the position where they will need to access either crystallising some of the gains within their portfolio or accessing some of the income generated from the investments. So they're not really in a position just to invest and then not touch it whilst they're here in Portugal. And therefore we need to look at several other options that would more closely align with that objective. So the first way of mitigating tax on an investment portfolio is to what we call wrap it. So if we consider the same investment portfolio growing over time, then if we actually wrap it, so we're not holding it directly anymore, we're actually putting a tax wrapper around it, then we can mitigate the effect of the ongoing capital gains tax, because within one of these structures, the aim is to lower the overall tax rate. So how do we mitigate this tax, the capital gains tax and income tax that we'd face if we're holding investments direct? Well, there's two common ways of doing it in Portugal. The most popular ways are via what's called a Portuguese compliant investment bond or a qualifying non-UK pension scheme, which is abbreviated QNUPs. Looking at the bond route first of all, so if we have the same type of investment growth as we did in the previous example, so it goes from 100 to 150. What the aim of the bond is to actually wrap and protect that investment. So it's no longer directly held. You could still have the same funds, the same managers, or ETFs, passive funds, trackers, but you're not holding it directly as such, you're holding it via a bond. And what the bond does is it gives you that tax protection. So instead of having the 28% capital gains tax, you have a 0% tax rate on the growth whilst it's rolling up. And also any dividends that's paid out, again, instead of the 28% that applies, you have a 0% tax rate. The other issue that this protects against is that short-term capital gains tax that I mentioned before, whereby if you're trading or holding the funds for less than 365 days, you're going to be hit by that additional capital gains tax because it's added to your income rather than the flat 28%. So again, by holding them within the wrapper, you can trade more frequently and not have to worry about those tax consequences. And then how it works over time is that over time the pot will expand in value, so your overall investment will increase. And then when you take money out, you're treated as taking a slice of the two components. So all this here, this is your original investment capital, that comes out at 0% because it's your capital. And then it's just this part here that's the taxable element, that's the growth element of the withdrawal. And that starts at 28% tax. But the important point on the bond is that the tax reduces over time. So after 5 years you get a 20% tax reduction, and after 8 years you get a 60% tax reduction. So you're paying a maximum of 11.2% after you get to the 8-year point. But even during the early years it can be very tax efficient. So if we just look at some numbers as an example, you put 100,000 into your bond, for example, it grows to 110k after 1 year, just to keep the numbers simple. And at that point you want to take a £25,000 withdrawal. So we're going to take 25k out, and we know that because the pot as a whole has increased in value by 10%, we know that 10% of that is the taxable element of it, so that's €2,500. If we then tax that at 28%, we have a tax rate, tax amount rather, of €700, which as a percentage of the withdrawal is just 2.8%. So even in the early years when you're paying the maximum tax rate, because you're only paying tax on the growth element of any withdrawal, the effective rates are still very low. And over time we see that kind of ballpark figure about consistent. So 3 to 5% tax on average is what we see, because although over time your investment value is going to appreciate and therefore the growth is going to be a bigger part of the overall pot, by that point you'll be into the tax reduction period. So you'll have the 20% tax reduction after 5 years and the 60% tax reduction after 8 years. The bond is also flexible in terms of what investments you put into it. As I said before, you can put a wide range of funds in there, passive funds, different currencies, so you could have it in euro, dollar, sterling, and you can have the underlying investment. So there's 2 levels of fund denomination: the overall pot, how you choose to denominate that, and then within the bond you can have a mix of fund denomination, so it's quite flexible if you want to, for example, split it between sterling and euros. I'll actually be doing a separate video just dedicated to Portuguese compliant investment bonds, hopefully going in a bit more detail about that particular investment. So if you want to be notified when I release that video, just subscribe to the channel. The next common form of investment that clients consider is what's called a QNOP, so qualifying non-UK pension scheme. And what that simply is it's an international pension scheme that has to adhere to a set of rules in order to be approved by HMRC. And if it does so, then it can actually be quite effective from an inheritance tax point of view, because money put into a QNOP is actually outside of your estate from an inheritance tax perspective. There are lots of caveats around this, and it's not really an IHT planning tool as such. It should be primarily a pension and retirement savings tool. But one of the additional benefits of using this type of structure is that, that if you plan it correctly and you set it up correctly, then it can have inheritance tax savings. If we look at the way it works, again, if we consider an investment that grows in value, we have the wrapper around it again. So instead of the bond, we've got the QNOPs here. This means that, as with the bond, there is no capital gains tax on the capital appreciation of the fund or the underlying investments, and there's no tax on the dividends paid from them either. So the QNOPs does act as a protection in the same way that the bond does. Similar in the sense that it's flexible in terms of investment. You can put a wide range of investments and currencies in there. Very cost effective if you set it up correctly. The major difference with the QNOPs is that there are certain rules around income, so it's not as flexible as the bond would be in terms of the amount that you can take out. And also there's a difference in tax treatment. So because it's a pension, there are different ways of reporting pension income in Portugal. And this is where it gets a bit complex as to how it should be seen and reported. Some people suggest that, or some accountants rather, suggest that 100% of any income from the pension is taxable at your scale rates. Others argue that when you take money out, you can apply what's called the 85-15 principle. So what you're saying is that 85% of the money that you're taking out is a return of the original capital that you put into the scheme, and therefore you're only declaring 15% of any income paid. So if you're taking a £10,000 withdrawal, you're just declaring €1,500 as a taxable income. It's a complex area in its own right, and if you wanted to speak to us in a bit more detail about that, we'd be happy to help. Another investment we get asked about from time to time, not a lot these days, but some clients have asked about investing directly into bricks and mortar property, so buying a property here in Portugal or also the UK. We're not really keen on property as an investment, to be honest. If you look at what the key items on the shopping list, so to speak, when you're purchasing an investment would be cost effectiveness, the ability to get in and out of it very quickly, and tax efficiency. They're three key issues. And if you think about property as an investment, it doesn't really tick many of those boxes because it's not cost effective in the sense that it's quite expensive to buy and also maintain, whether you're using letting agencies or just the ongoing cost of maintenance. There may be issues with tenants and periods where it's vacant, so you're missing out on rental income. And then we all hear of the cases of nightmare tenants, which is going to affect the return as well. Also, most of our clients are in a position where they've built up businesses and sold businesses or large property portfolios. They're looking to get out of property at this stage rather than into it. Also, the practicalities of trying to manage and maintain a property that may be in the UK, for example. If you're now living in Portugal, it's going to be practically difficult to do that. If you need to access money quickly from the investment. It's not possible with property as it would be with some of the other investments we've discussed earlier. In fact, these days there are actually incentives to be getting out of property rather than into property. And I'm thinking mainly from a UK context. We have provisions in UK capital gains tax rules that state that if you're selling a buy-to-let property, you only pay tax on any gains since 2015. So if you bought the property, for example, in 2000, any gains or any increases in the value of the property between 2000 and 2015 are washed out, and you only pay tax from 2015 until the point you sell it. So from dealing with many clients over the last 10 years or so, we found that it's given quite good results, and they've been able to get out of property or property portfolios, in fact, at very low tax rates. Just to finish on two final options that we've been asked occasionally on is firstly company-held portfolios. In the past this was more common than it is now, but we find that the costs of running a company to house an investment portfolio is expensive. Choosing the jurisdiction to hold the company and analysing the double taxation treaty between Portugal and that jurisdiction, again, is more complex. And there's also been a tightening of tax rules, which means that it could be ineffective to use a company as that type of tax wrapper to try and mitigate the tax on investments. So I'd probably shy away from company-held investment portfolios. And the final one that we're asked about and was used in the past quite commonly in Portugal is trustee-held investments. Trusts now, I would suggest, are more appropriate for those that are looking to gift assets to the next generation but aren't necessarily wanting to relinquish control of them. It's not necessarily the best structure to hold if you're looking to take income from the investment, because you're going to be subject to a flat 28% tax rate on any income taken out of the trust, and that applies even if the underlying investments are at a loss. So it's not an ideal position. I'd say the main contenders for clients living in Portugal or looking to relocate here in the future are, to summarise, the general investment account, the Portuguese compliant bond, and the qualifying non-UK pension scheme. If you want any more details of those three options and how they'd apply to your situation, we'll be happy to talk through them with you, and I will see you soon.